Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And lately we've been digging into some 13F reports of the big tech companies like Nvidia and Amazon, finding some great stocks like SoundHound AI, up 729% this year alone, and Amazon's investment into IonQ, up 326% in less than 3 months. Alphabet is playing a completely different game though, with more stocks than both of them combined, and 23 of the 39 companies with market caps under $1 billion, those fast-growing penny stocks. I highlighted Alphabet's 7 largest investments in Friday's video. Now let's take a look at those moonshot penny stocks the company is buying, along with the stocks and news I'm watching this week. We'll get into those penny stocks Google is buying, but it's all going to be pointless if you don't start with an investing plan right for you. It's why I created a quick 3-step guide to making your investing plan. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing, and that is customized to your needs. I'll leave that link below in the description. It's totally free, just something I wanted to put together for all you out there in the community. So click through and get your step-by-step guide now. Nation, I've seen too many investors miss out on that opportunity to make their money work for them, and it's because they didn't have a plan that fit their needs. So look for that link and get your free customized plan. We've already covered the 6 stocks Nvidia is buying, up an average 64% in the last 6 months alone, and the 10 stocks Amazon is buying, an investment of $2.2 billion in stocks that are up 84% in just the last 2 years. But Alphabet, aka Google, has them beat, investing in more stocks than both of those combined. Not only is Alphabet investing in more companies, but it's using an entirely different playbook. Instead of investing for strategic purposes, as Amazon is doing locking in its transportation partners or supporting demand for its products, as we saw in Nvidia's investments in companies that are going to buy its chips, Alphabet is all about the return. I showed you the company's 7 biggest investments Friday. 7 stocks Alphabet has invested $1.75 billion, or 80% of its total public stock portfolio. But that's not where Google is really gearing up for those gains. No, Google is going after the big wins in penny stocks of biotech and medical research companies. Nearly 3/4, 28 of the 39 stocks are in biotech or experimental healthcare companies, and 23 of them are companies with a market cap under $1 billion. Those penny stocks we'll talk about today. But before I reveal that penny stock list and the top 5 on the list, I want to make sure you know what you're getting into. Some very risky, potentially high return, but very risky stocks. And most important to this, a point that I made on Friday's video about these biotech stocks and why we really don't cover them much here on the channel. I pointed out Revolution Medicine and the dozens of research slides it takes you through on its presentation for this clinical stage development and the hundreds of pages of research and testing behind each of those slides. But to most investors, including myself, those slides just are going to look like a foreign language. To be successful investing in biotechs, you really need to understand not just the research, but also the clinical trial schedule and the FDA approval process. And yes, you can piggyback on investments like these, like the ones Google is making right now, made by a team of analysts that have gone through all that research, but without that deep experience in the industry, whether in pharmacy, healthcare, or drug development. You're going to be waking up one day to find your drug stock has crashed 70% because a trial for one of its indications just failed. I'm going to highlight 5 of those penny stock biotechnology companies Alphabet is buying, but unlike other videos where I do that deep research into the companies, the intent here is just really to show you my thought process on narrowing down a list of penny stocks. I'm not going to pretend to know which company has the best potential blockbuster drug because it wouldn't be honest. Use this process, though, anytime you have a big list of penny stocks, like the 23 here we see in Alphabet's 13F filing, to narrow down your list to start that deeper research. And here I started with that full list of 39 stocks Alphabet is buying and copied the market cap from Yahoo Finance. Now that's the total value of the company's shares. Then filtering this list to those under the $1 billion market cap gives us our penny stocks. Because remember, it's not about stock price. It is those super small companies with the room to grow to 10x your money. And here, revenue growth is one of the most important factors in penny stocks, second only to cash. So first, I looked for a 2-year annualized growth rate. Now this can be based on reported results on the income statement or analyst forecasts. One major problem here is that many biotech stocks have extremely lumpy revenue, booking hundreds of millions in years of big partnerships, and then nothing in another year. Again, that's where having that experience in the industry to assess a company's drug pipeline really comes in handy. For most penny stocks, though, I like to see at least 15% or more annual revenue growth, so wouldn't generally consider a company under that unless I had a special insight into its growth. Earnings are not generally as important for penny stocks, especially biotechs that are going to report years of losses until that one big blockbuster discovery. Positive earnings, or as close to positive as possible, are nice, but it's really that cash flow that is more important here. And for that crucial cash flow number, I'm going to look into this company's statement of cash flows. This shows the actual cash generated or spent by the company and is less skewed by accounting practices that make income look better. Free cash flow, or FCF, is the operational cash flow minus any investment spending that the company has to make regularly. In a healthy company, it's the cash left over for investors after paying the bills to keep the company running. FCF is generally negative in penny stocks because they aren't generating much in the way of profits yet and are investing heavily to grow, but you'd like to see that lower negative number, or at least free cash flow that is getting less negative. Now, combining FCF, that free cash flow, with this ending cash is where I make my decision in many penny stocks. This ending cash on the statement shows the cash reported on the balance sheet at the end of the period, and that cash is like oxygen for these small startup companies. With enough cash to cover another year of negative cash flow, a company may have a chance to grow into profitability. Without that cash, though, without that oxygen, the company is going to suffocate unless it gets put on life support. And that is where we see a lot of these alphabet penny stock investments, deep negative cash flows, and cash reserves to last a year or less. Of course, companies with the confidence of an investment from Google Ventures are likely to get that follow-on funding through convertible debt or a share issue, but that's going to dilute existing shareholders and maybe only delay an inevitable bankruptcy. So among the 23 stocks reported on Alphabet's 13F report, only 6 of them are posting 2-year annualized revenue growth of even 10% or more. 4 are posting exceptional growth that would make me want to look further into the stocks. Autolus Therapeutics, ticker AUTL, Benson Hill, ticker BHIL, Barinthus Biotherapeutics, BRNS, and Hyperfine Inc., ticker HYPR. Now again though, the lumpy nature of biotech revenues means a closer look is needed in a lot of these stocks. For example, Verve Therapeutics, ticker VERV, is expected to grow revenue by a stellar 99% this year, but then to see it fall by 42% next year for an annualized rate of just 7% over the period. And then moving to this cash flow and the lifeline that comes with that high cash balance, 4 of the penny stocks with strong growth also report enough cash to cover more than a year of cash burn. That's AUTL, BRNS, HYPR, and then Planet Labs, ticker PL. Now, I'm including Planet Labs here, even though it's technically over that $1 billion market cap and under 15% revenue growth, because it's possibly the next closest to profitability. Next year's earnings are expected to be just 7 cents in the red, and the company has $149 million in balance sheet cash against free cash flow of negative $66 million over the last year. Looking now at the stocks I'm watching this week, Micron Technology, ticker MU, reports its earnings on Wednesday in what could be the next stock to benefit from that AI data center buildout. Revenue from its data center segment reached a record last quarter with its high bandwidth memory, or HBM solutions, and data center SSD products. The downside here, as with others, is that Micron isn't a pure play on the theme and is really being held back by slower growth in PC and mobile phone segments. Still, growth is very good here, with the quarter expected to show 84% revenue growth and for 22% next year to $46 billion. Better still, that growth comes at a very low price compared to other tech stocks, with the shares trading for just a price of 11 times this year's earnings and 4 times on a price-to-sales basis. I'm also watching a group of 7 stocks that could be the next Magnificent 7, up an average 37% in the 3 months since I highlighted them in a video, well above the 5.4% return on the broader S&P 500 index. Now those companies are SoFi Technologies, ticker SOFI, Snowflake, SNOW, Datadog, ticker DDOG, CrowdStrike Holdings, CRWD, ServiceNow, ticker NOW, The Trade Desk, TTD, and UiPath, ticker PATH. While shares of SoFi have gone exponential over the last couple of months, I'm particularly interested in Snowflake and Datadog, which both surprised the market with their strength in their earnings results. Giving you a look into that bigger picture with the Sector Spiders Sector Tracker, just 2 of the 11 stock sectors closed higher last week, and even that was only on the back of a few big stocks. The communication services sector finished up 0.01% on Alphabet, which accounts for 20% of the sector weight, and its 8% gain. 15 of the 22 stocks in the sector closed lower though, so it was mostly lower. Then the consumer discretionary sector finished just over 1% higher, but only on Tesla, which is also 20% of that sector's weight, and its 12% run to a new high last week. Here, 38 of the 50 stocks in that sector closed lower, so again, not as good as it looks. 1 week doesn't make a trend, but the broad weakness does confirm the idea of exhaustion among investors and maybe the need for a slight pullback. Looking out longer term here, while stocks in the consumer staples sector did supply some of that traditional safety in the sell-off, other safety sectors like utilities and healthcare failed to provide that shelter. There may be little safety in utilities if the market does pull back after the sector has already jumped 23% so far this year. Now, real estate could still provide some relative safety on those lower interest rates and an underperforming 6.9% return this year, but it's really probably in bonds and funds like the iShares U.S. Aggregate Bond ETF, the ticker AGG, that's likely going to provide the best protection in a short-term sell-off. Get your customized investing plan and make sure your investments are right for your goals. All free with the quick sheet linked in the description below. Or click on the video to the right and see those 7 stocks Amazon is buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.